Let's go now to our business reporter, Ed Boyd, who's at Martin Place live for us. Ed, this decision takes us to a 10-year high for the cash rate.
Yep, cash rate here and at its highest level since the end of 2012, so a decade. I'm joined here in Martin Place outside the RBA's headquarters with Besa, Deda, the St George Bank chief economist. Besa, RBA lifting by 25 basis points. Was that what you were expecting to cap off the year?
Yes, that's exactly what we were expecting, and most economists around town were also expecting that, so that takes the cash rate to 3.1%, the most tightening we've seen in 8 months since inflation targeting began back in the early 1990s.
We're starting to see some signs of inflation cooling in the economy with the numbers coming out from the ABS last week. Do you think the RBA is going to be encouraged by that data?
Look, there's some very early signs from that monthly inflation indicator, but we really can't be too certain given it's only 1 month's worth of data. So I think the inflation pressures in the economy still warrant very close monitoring. Interestingly, the RBA has stressed they need to watch wages growth and developments in the labour market to avoid a wage price spiral. So it does seem like they're a little bit more concerned about wage pressures, and certainly in the latest set of data from the wage price index, it did show that wages are starting to show an acceleration, especially over the last 6 months compared to the 18 months prior.
RBA now has the rest of this month off and January off. Do you expect them to lift the cash rate again next year?
We do expect more tightening to come, and even in today's decision, they flagged that more tightening is likely. So our view is that they will hike again in February after a natural pause in January when they don't meet. But then after that, they could possibly pause, even though we still think that the cash rate will move higher still.
Where do you expect the cash rate will peak? What's the sort of percentage?
Look, our view is that the cash rate will go to 3.85%. There is a risk that it might be a bit lower than that, given that the global economy is turning down. And also we know that monetary policy has long and variable lags. And between now and the end of next year, there's a high share of Australian households on fixed loans that will roll over onto a higher variable rate. And that is going to start biting, particularly on consumer spending growth.
Next week, the US Federal Reserve holds its board meeting, and then they've got another one at the end of January. The cash rate in America could be 5% by February next year. Is there a bit of a risk Australia's economy and the Reserve Bank here is going to be left behind?
Certainly that's correct. We do expect that the Federal Reserve will hike at both those meetings, and you could see a cash rate as high as 5% in the Federal Reserve. Look, the Reserve Bank will keep an eye on what other central banks around the world are doing, and they have to, because what our interest rates are compared to that of other major economies around the world has a bearing then on the exchange rate. And the exchange rate's value then can impact the price of imported goods and services. But I don't believe the RBA will have to take the cash rate as high as what it is in the US, because I don't think the inflationary pressures are as strong as what they are in the US, especially in terms of wages growth, but it deserves monitoring, obviously.
And tomorrow we get the GDP numbers for the September quarter. Are you expecting that to be a pretty standard figure coming out from the Bureau tomorrow?
Yeah, we're looking for still a reasonably robust number of 0.8% in the quarter, which still leaves annual growth at a very solid rate. But we should start to see some signs of a slowing coming through in those national accounts numbers. And I think in the next set of numbers in the next quarter, you will see a deeper signs of slowing coming through. And then over next year, we are looking for much softer economic growth to transpire.
And as Australia's cash rate has risen this year, property prices have been falling. Do you think prices will continue falling into next year?
We do expect that slowdown to continue over the rest of this year and into next year, but I wouldn't be surprised if you see some stabilisation in prices emerge around the middle of next year in some markets like Sydney. And that's primarily because there's not much stock, population growth is ramping up, rental growth is very strong, and investors might start to take a bit of a look at housing. But whilst we might see some stabilisation in some markets around the middle of next year, we're not expecting to see a recovery in dwelling prices until rate cuts get a lot closer, and that's really not a 2023 story.
And the global risk of a recession next year, how big a risk is that still for us in Australia?
We don't see a high risk of recession in Australia. I'd probably place the probability at about 35 to 40% locally. But I think there is a high chance that the United States will go into recession. You can throw Europe there as well, particularly with the energy crisis that they're dealing with. The US will have a much higher cash rate, and they are talking tough as well as walking tough. And I think they're more prepared to take a hard landing in order to bring down inflation, whereas the Reserve Bank is trying to finagle bringing down inflation while also managing to achieve a soft landing with economic growth.
So the fundamental signs of our economy are still pretty good.
They are right now for the moment, but we are seeing those signs emerging of slower consumer spending growth. Consumer sentiment remains very weak, and it has been for much of the year. The jobs market is very robust, and obviously need to see more signs of a slowing coming through to get closer to that peak in the cash rate from the RBA.
Well, Besa, Deda from St George Bank, thanks so much for your time today.
Thank you so much, Ed.
Well, there you have it, Kieran, an 8th rate rise for the year. Cash rate at 3.1%, but it sounds like it's going to be lifted even more as we head into next year as well.